What is quantitative finance? Today we're kicking off our quantitative finance series. 5 episodes covering the math, models, and methods used by the smartest money on Wall Street. Whether you want to trade algorithmically, land a quant role, or just understand how markets really work, this series is for you. Quantitative finance is the application of mathematics, statistics, and computer science to financial markets. It turns vague questions like, is this stock cheap? Into precise, testable models. Quants use probability theory, stochastic calculus, and machine learning to price securities, manage risk, and build trading strategies. Quant finance splits into 3 branches. First, derivatives pricing, using math to value options, swaps, and structured products. Second, statistical modeling, finding patterns in market data to predict prices or returns. Third, risk management, quantifying how much money a portfolio could lose and keeping it within limits. Hedge funds like Renaissance Technologies, 2 Sigma, and Citadel run billions of dollars using pure quantitative strategies. Investment banks employ quants to price complex derivatives and manage trading book risk. Asset managers use factor models to build smarter portfolios. Central banks use macro models to forecast economic conditions. At the core is probability theory. Financial prices are modeled as random variables evolving over time, called stochastic processes. The most foundational is Brownian motion, a continuous random walk that describes how prices drift and fluctuate. From there, stochastic calculus, specifically Ito's lemma, lets us derive pricing formulas for derivatives. Quants work with return series, the percentage change in price over time. Key statistics are mean, expected return, standard deviation, volatility, correlation, how assets move together, and skewness and kurtosis, tail behavior. Real financial returns have fat tails. Extreme moves happen far more often than normal distributions predict. Python is the dominant language. NumPy for matrix math, Pandas for time series data, SciPy and stats models for statistical tests, Matplotlib for visualization. For production systems, C++ is still king for latency-sensitive work. R is popular for academic research and econometrics. Quant researcher develops alpha signals and trading strategies. Quant developer builds the infrastructure to execute those strategies. Risk quant models portfolio risk and regulatory capital. Pricing quant values exotic derivatives for trading desks. Salaries start at $150,000 plus, with top quants at leading funds earning 7 figures. Episode 2, Options and the Black-Scholes Model. How Math Revolutionized Derivatives Pricing. Episode 3, Statistical Arbitrage. Pairs Trading and Mean Reversion Strategies. Episode 4, Algorithmic Trading. Building, backtesting, and executing systematic strategies. Episode 5, Risk Management, VAR, Stress Testing, and Portfolio Risk Frameworks. Quantitative finance is what happens when mathematics meets money. It's rigorous, data-driven, and increasingly dominant. The firms that win in modern markets are the ones with the best models, the best data, and the best execution. Understanding these tools puts you in that conversation. See you in episode 2.